All right, good evening, everyone. Glad that you were able to make it here to our passive investing mastery session. That's what we should all be looking for right now, is how to master the art of passive investing into not just traditional assets, but alternative investments. And what the heck are those? And who do we call and know to get into those that will outperform and hedge against the stock market, right? And that are somewhat hedged against inflation, and are there things that can protect us from rising interest rates? All these things that are buzzing around the heads. And then the golden word, the golden goose, is cash flow, right? And that's what we were talking about, is cash flow. And that's the buzzword that investors have been talking about. There's some interest rates are drying up things, inflation's making things harder, economies maybe heading into recession. How do we get sustainable cash flow? And so I've got a whole cast of characters here on this panel. I couldn't ask for a better group. They're just all incredible people that I've got the pleasure of getting to know in this investing space, that have huge followings and just a myriad of all kinds of experience. I'm going to go ahead and let each of these individuals introduce themselves, but you're going to hear about, guys that are involved here in parking lots and mobile home parks, oil and gas, multifamily, debt, income, all these great sort of things today. We're going to go through all that. We've got a bunch of really good questions. Please be very active in the chat. The whole point of this is for you. It's for you to learn and us to share our knowledge with you. And Blue Ocean, like the lake I have behind me, everything that you want is open for grabs here. So, and we've got some people like Andy's been on, and Kevin. I know these guys have been on Under the Gun and open forums many times in the past. So please keep those questions coming. So let's go ahead and get started. Alternative Investing Mastery Series, Strategies for Sustainable Cash Flow with Passive Investing. I'm going to go ahead and let Courtney, and then we'll go to Kevin and Andrew. And why don't you give us who you are, where you came from, what you're doing, 2-minute intro to yourselves.
Yeah, so I'm Courtney Moeller. I am a general partner for Diversified Investment Partners, and I am originally from West Texas. I was born and raised to a petroleum engineer and literally grew up riding pump jacks on a Friday night. So we've lived all over the world drilling oil, and a few years ago, I needed to diversify outside of oil and gas because it's really great when your entire portfolio is oil when it's at $100 a barrel, and it's not that great when it's $30. So really jumped in. I've been really fortunate to do panels with Robert Kiyosaki and G. Edward Griffin, some other really incredible people, and learned about all these different asset classes. Thought I was going to syndicate multifamily and other things, and figured out very quickly that the tax advantages and cash flow of oil and gas pair very nicely with these other asset classes. I love real estate. I love mobile home parks. I love cash flowing businesses. And so I really delved into that and found the people that really dominate those asset classes, that have that handful of experience. And it's been a fantastic ride. I'm truly honored to be here, and I'm looking forward to sharing and getting into this conversation with everybody tonight.
Awesome. All right, Kevin.
All righty. First and foremost, Patrick, appreciate you having me here. Excited to be here with everyone on this panel. And Kevin Bupp, principal and co-founder of Sunrise Capital Investors. We specialize in mobile home parks and parking assets, such as parking lots and parking garages. However, my time goes back many years prior to Sunrise Capital. I like to say that I've never had a real job. I found my way into real estate back when I was 20 years old and bought my first rental property in a really low quality neighborhood in Harrisburg, Pennsylvania, where I was born and raised. Fast forward a few years, I built up quite a large portfolio of single family properties in my early to mid 20s, about 150 to be exact, and also a few hundred multifamily properties. Fast forward a couple of years after that, found my way into commercial real estate, numerous asset classes. I don't know if there's a particular asset class of the major food groups that I haven't been involved in or I haven't owned per se. Office, retail, self-storage, industrial, the list goes on and on. But fast forward again a couple years, 2011, I was introduced to mobile home parks, and that really has become what is our bread and butter. It's what we specialize in. We've been doing it now over a decade. So bought my first mobile home park back in 2011. Formally started Sunrise Capital Investors in 2016. Prior to that, it was mostly my own capital or capital of friends and family, or just strategic investors. But in 2016, we launched Sunrise Capital Investors, and have since been able to work with hundreds of partners across the country, and bring just the phenomenal investments that that mobile home parks and parking provide to many different families, again, across the globe, and with the intent of really creating cash flow and legacy wealth for all the different folks that we work with. So that's a quick background on myself.
And man, I've heard stories about Kevin Bupp now for many, many years, and this is the first time we've ever been on a panel and formally gotten to hang out together. So really excited about that.
Hopefully they're all good stories.
And similar, you've got Mr. Cushman here, and this guy goes way back, and he's been a thought leader for more years than I've been in the business, I think. So Andrew, why don't you let us know a little bit about what you're up to?
Yeah, that's evident. Yeah, I've been on enough webinars and podcasts that you can chronicle the advancement of my gray hair over the last decade and a half pretty easily, depending on how far back you go on YouTube. But I took the standard path into real estate and got a chemical engineering degree. And I think you'll find about 56% of multifamily guys came from the engineering group. That was only a placeholder. I knew that when I got it. I just wanted to do something else. I just didn't know what. 2006, my wife and I discovered flipping houses. And 2007, we got our first one, flipped it, and made as much as I made all year at my job. So despite the impending recession and crash, I said, that's it, I'm out. Let's go, flip full time. It was a great time to do it because everyone was scared. No one wanted to touch real estate. We had no competition. So we had a great run for a few years, but we realized pretty quick that you're only as good as your last deal. You buy a house, you fix it up, you flip it, you hopefully make a nice check, but you got nothing left to show for it. You have to go find the next one. And so we said, kind of sat down and said, this is great, but like, what can we do that's more scalable and builds more income, more wealth, and more passive income? Although if you're an operator, it's not passive, but that's a different discussion. And we said, well, we just had a huge recession. So that means we're probably going to have a long expansion. Number two, everyone just got foreclosed on and can't buy a house, or they know someone who got foreclosed on and they're afraid to buy a house. So expansion, job creation, no one can buy a house. Okay, rentals are probably going to be a really good thing to get into. That was 2011. We went and found a mentor. He kind of held our hand and guided us through the process. Our first deal was a 92-unit apartment complex out in Macon, Georgia, on the other side of the country. I'm a big believer in live where you love to live and invest where the returns are the best. Mm-hmm. So I, like Patrick, I live in Southern California where I can surf and snow ski on the same day and enjoy like the weather you see behind Patrick now, 362 days a year. But we invest in the Southeast, so Florida, Georgia, and the Carolinas, where the demographics are really good. There's job growth, income growth, population growth. It's landlord friendly. It's business friendly. They appreciate you coming in and investing there. And we've been doing that full time since 2011, just a little over 2,700 units. We hoped it would be more units than that, but the last few years we haven't bought a whole lot because it was very difficult to do so responsibly. We're getting excited that might be changing soon. And the next 18, 24 months could be the start of could lay the foundation for the next upcycle. And so we're getting excited again. So.
And that's an awesome story. The wisdom here about being true to your convictions and not buying when you don't feel like it's the right time to buy is the sign of a great individual. So my name is Patrick Grimes. If you don't know me, Passive Investing Mastery is one of our companies. We have about 5,000 units in multifamily that I'm a co-sponsor in. We do a little bit of energy as well, like Courtney. I actually came from a little bit of a background where my great-grandfather, Courtney might know this, was actually in oil, and we have an oil trust as a result, as it turns out. So, but I came from a high-tech background, more similar to Andrew. I did machine design, automation, and robotics, and the first design firm I worked for said, go invest in real estate as much as you can, as soon as you can. that led me to hitting the ground running before 2009 and 10, getting way over indexed and losing everything in pre-development. And I was personally guaranteed in. So I learned how to fail quick. And then I learned how to invest like the tortoise and not the hare. And so then I got into single family and then traded up in larger multifamily. We have a debt fund now, so we're investing a little lower on the capital stack, both debt and equity, to provide a little more consistent cash flow. And so we're kind of building out a little more alternative investments now. And like Kevin, not just multifamily, we have some retail now and a little bit of industrial, right? So crazy stuff, but I mean, really opportunistic for the timing in the market. And Sean, Linda, great comments. Keep the chat going, keep it rolling. Let's hear what everybody has to say. We're going to be sharing some opinions here. And if you don't think we're on the right track, tell us. If we're on the right track, tell us. Okay, so I want to start this off. Why are we talking about cash flow? What is the need for cash flow? And how do we balance it? Everybody's coming to me saying, oh, wait, we want the cash flow and the yield all at the same time. Or they say, hey, look, I want the ability to have fixed, predictable cash flow in my portfolio versus, hey, I want a 2 or 3x return on yield. I want to retire in half the time. How do you balance that cash flow and yield conversation? Because we need cash flow to survive on, right? And cash flow sometimes is a litmus test for the health of an investment. Is it already cash flowing, right? And that's what I learned during the big crash because I was kind of leveraged out on development. There was no cash flow, so I all came crashing down. So let's start with Andrew. He's a big cash flow guy. He's got strategies for cash flow. How do you balance cash flow and how do you balance appreciation? And what advice would you ask investors on this topic?
Yeah, the reason cash flow is so important is it gives you options. One of the beautiful things about the investments that are represented on the screen, and especially the real estate ones, and not to I just because I don't really know oil and gas. So Courtney, correct me if I misspeak or but one of the beautiful things about real estate is in most cases time is almost always your friend, right? If you hold long enough, you're probably going to come out okay between inflation and appreciation. You can claim depreciation. Rents typically go up. If you wait long, unless you bought in a declining area, if you can hold long enough, you're probably okay. And the key to being able to do that is cash flow, meaning, if you look at what's going on in the commercial real estate market right now, the reason a lot of properties are running into trouble, in addition to the fact that a bunch of people got short-term loans that are coming due, but what's making the problem even worse is they can't refinance because the cash flow isn't there to support the new debt. And so what happened, for those of you who might not be familiar with floating rate loans, in 2021 and 2022, everyone could go out and get a 2% interest rate loan on a multifamily property, and it looked great, except that interest rate was indexed to something like SOFR. You don't have to get into the specifics of that, but basically, if the Fed moved rates and market rates went up, then the rate on that loan went up. Well, all of a sudden, the Fed comes in, bumps rates 500 basis points. The mortgage payments have doubled, tripled, and sometimes quadrupled on these properties. And now operators are losing them because they don't have the cash flow to keep them. I was just on a call actually earlier today with an operator who did buy a bunch of properties in 21 and 22, which is the peak of the market, but he fixed his interest rates and he made sure he has the cash flow to cover those mortgage payments. And guess what? He's fine. He's not he's not cash flowing as much as he wants right now, but his plan is to just sit and wait until 26, 27, 28, whenever the market changes and is favorable. And then the value of his property should be a lot more. So like that, to me, like that is the key. Cash flow gives you options. It gives you flexibility. We love to talk, here on podcasts, everyone's like, oh, buy a single family house and retire on the cash flow. Yeah, I don't know if that's actually going to happen. It takes a lot of them, but if you focus on cash flow, then it gives you the options to hold and to do the things that can create equity down the road, or appreciation, or double your investment, all that, as long as you get the cash flow to begin.
Yeah.
Kevin?
Yeah, no, I mean, cash flow is king. I mean, just to kind of piggyback on Andrew's sentiment. I mean, I think, I think you can actually have your cake and eat it too, because I'm a cash flow guy. I mean, and I always have been, right? And however, we like that. We like those big yield pops as well. We like that growth opportunity. However, it's most things it's impossible to have both, but I think you can have both. And we actually, our company, like we buy a lot of value add, like we've always done that, right? But we typically like to buy value add that actually has cash flow from day one. So it's kind of somewhat stable with upside potential. And so what we've found is that there's a great opportunity to kind of marry the two together. And so we don't do deal specific syndications like a lot of folks do. We found out there's a lot more benefit and a lot more flexibility for our investor base by doing these growth and income funds. So it's a combination of the two. And so it's diversified in the fact that, we buy stable assets that also have some value add potential. A lot of times it's growth potential, but they're cash flowing from day one. But then we also compare that with, high value add deals, more growth opportunity deals, and kind of blend the two together. And this allows investors to, to realize steady income from day one, because a lot of folks need steady income day one. Like they need that steady Eddie, right? They need that consistency, that predictability. And that predictability doesn't necessarily always exist with your typical value add deal. However, we've married the two together and allows them to partake again in that immediate cash flow, but also have that growth opportunity down the road as well. And so again, but cash flow is king for me. I've always been a cash flow investor. I mean, first and foremost, that is the most important to me. Whether it's a single asset or we're building out a fund, can we start paying cash flow fairly quickly? Or, if we can't, if it's truly just we're going to hope and wish for the best in 3 years. The underwriting looks phenomenal. The pro forma looks great. Like we're going to do incredible in this deal in 3 years. And then, the Fed starts bumping rates like they did a couple of years ago. And all of a sudden we found ourselves in hot water and we're in a very unpredictable environment. And so I'm a very much cash flow guy. And again, just agree with everything Andrew said and pass on to Courtney. We'd love her perspective on this.
Well, I know Courtney hangs out with Robert Kiyosaki on the regular.
There we
so
go.
I have a feeling I know what's going to happen.
Gosh, well, I think really, I've made that mistake where I was just kind of investing in all kinds of different things and hoping that I was going to, get this cash flow. And I had all of these goals. And I think really it's important to sit down and take an assessment of what you have, what your goals are, what you're trying to accomplish, and make sure that you are getting into assets that are going to get you there. And really, I'm very big on being diversified. I want parking lots. I want mobile homes. I want multifamily. I want oil and gas, because all of these assets are cyclical. Right now we're seeing some struggles in that multifamily space. I'm feeling that, a lot of the apartment complexes I'm invested in aren't cash flowing, but oil and gas is, paying really well. My self-storage funds that I'm in are paying very well. But, a couple of years ago, real estate, I wasn't having any issues with that multifamily, but like my oil and gas deals were paying great. So I think this is why it's important to be in different classes, because they are cyclical and things do change. There's interest rates are affecting everything now. And I know we're going to get into the due diligence and things like that here, coming up, but it's really important to be with operators that know what they're doing, that have a good knowledge of what these cycles look like and how to navigate them. Like the guy that got into that fixed rate debt a couple years ago, that was brilliant. I'm sure everybody is wishing they had invested with those people. And not just that, but I've been talking to several people recently that had the foresight to stop and pull back. When everybody's excited and everybody's making money, that's probably about the time to get out. And actually right now that there's all this blood in the streets, this is actually the time that, everybody's scared to redeploy their cash, but this is actually when the smart time to move back in, because
absolutely right.
that's when you really start making money. So, and people are afraid, but right now is the time. And really, that stock market's just a trend of human emotion.
Mhm.
But we've got to break that cycle of, buying high and selling low. Get out when everybody's excited, everybody's making money. Sit on the sidelines, wait for that opportunity, and now those opportunities are emerging. And now's the time to start redeploying and making sure you're redeploying with the right people.
Well, I 100% agree. We got some great comments here. Cash flow is king. Cash flow will retire you or make you crazy if it's not flowing.
If it's
Yeah.
negative, yeah.
To
Yeah.
find the cash flow deals, you got to dig. We got some really good ones here. So here's another one. Interested in hearing the panel's thoughts on investing in larger multifamily, given the sentiment. I think lots of us have pointed at it right now because not only has interest rates risen, and there was a lot of variable debt. Even if a rate cap was bought, that means the debt service, the debt payment went up to meet that cap, right? Or it was fixed. But even if it was fixed, we've seen not only interest rates, but we've seen taxes go up. We've seen insurance doubles in some markets of 30% at least nationally.
Yeah.
And in addition to all that, we saw COVID delinquencies in multifamily. And I know in Atlanta, they're still backed up in some counties 6 months to evict, some counties 15 months to evict. So I mean, there's blood in the water, blood in the streets right now. Not in this water, but somewhere there's water, and it's challenging. The investor sentiment's low, and so that's an alt assets. And I think Courtney pointed at what are the non-correlated investments. What does that mean? Things don't rise and fall together, and that's why we did some energy stuff. That's why we're in equity in acquisitions and we're in debt. And I think that's the real key. And there's to the mobile home parks, the parking, right? And in addition to Andrew's multifamily, there's a lot of opportunity there. And I think to get both, you really have to work. But if you look at the allocations of the wealthy, and we put this out on our decks, and the Tiger 21 allocation is 7% in fixed income. That's not tax advantaged. That's not yield. That's just cash flow, right? Low risk cash flow. And that points to another comment about you pay your bills with the cash flow and you get wealthy with the equity. Those don't have to, you can find assets that potentially are all the same, but look at the wealthy. I know Andy, he invests in T-bills, right? So there is an allocation for just income when you get to the the middle class, not so much, but you get to the ultra wealthy, you see how they allocate. They've de-risked it by doing some fixed income.
And the interesting thing, Patrick, is that we kind of harked on, and we've been harking on multifamily just because it's the one that's seeing a lot of the turmoil now. Just given the capital structure that a lot of folks took on over the last couple of years. But really, at the end of the day, I mean, the underlying fundamentals of multifamily are phenomenal, right? So we can't argue that point. And I think what it really I think we also can all agree, because we're all in different asset classes, we can all agree that there's an unlimited amount of ways to make money in real estate. There just are. We're just talking about some of the ones that we really like, right? But there's other methods as well. And I think what it really comes down to, especially in trying times like this, what becomes very important, forget about the asset type, for the points of this conversation, but let's focus on the actual sponsors themselves, right? Because it's the jockey, right? It's the jockey that's actually, riding that horse and is going to hopefully carry it through the finish line and actually have the wherewithal to do so. And so, it's just, we focus on mobile home parks and parking lots, right? Like they're recession resistant, all of us are in asset classes that are recession resistant. Mobile home parks had the lowest default rate during the last recessionary period coming out of it, 2008. And, we love that asset class, but I think, or I know that even today there's investors I know, I'm not going to name any names, but there's guys I know that were just a little haphazard in their investing over the last couple of years. When things were hot, everyone's buying, you can't go wrong, right? Rates are always going to be at 3%. They're buying mostly for appreciation. These things weren't cash flowing, and they're in trouble now. So it's not just multifamily; it's also even mobile home parks. And mobile home parks have an historically low default rate. But with all that being said, speaking to Andrew, you're the individual that you mentioned that he was very responsible. He invested responsibly. He put fixed rate back in and years ago when maybe it probably wasn't viewed as the the most responsible decision, right? Like he wasn't producing as much cash flow or maybe distribution to his investor base, but today he probably looks like a god, right? He's got a very low risk portfolio. He sleeps at night very well. And so again, just harking back, it really becomes the sponsor. Who are you investing with? Making sure that you're spending your time to vet the sponsorship group. What's their background? What's their track record? What's their balance sheet look like? Not just from a company side, but also on a personal side. Like, do they have the financial wherewithal and the means to actually carry you through the storm? And even in the best of asset classes, in recessionary periods of time, like there's bumps along the way, right? And so you want to be with the right jockey during those challenges. So anyway,
I love it. I think that leads. I think that leads right into the next question here, and the comments are very much in line with what we're seeing. We call it multifamily. I think they called it the something stepchild, and we've got the increased documents of fraud in some areas, and that goes back to it's about the sponsor, right? Yeah. We've got some comments here about what are assets, and let's go straight into that. So what is it? What are the specific investment strategies that we can recommend and that you found consistently have provided? And lots of us have been in the game for a very long time. We've seen the cycles. We've seen the cycles in different asset classes, right? And why don't we go ahead and who wants to take this one?
Yeah, Courtney, you want to go first this time?
Courtney, go for it.
Okay, so tell me that question again. I thought we were going into due diligence and mitigation.
Oh, sorry, I'm deviating a little bit.
No, that's okay.
What are the specific passive investment strategies that we found over the course of our careers and throughout our observations of different investment strategies? What are the ones that seem to be reliable? Which ones provide that steady cash flow, even in potentially downturns? And which ones provide great cash flow that may not be as recession resilient too?
Well, okay, so I'm diversified a lot amongst a lot of different asset classes. And even though multifamily hasn't been paying out, it's been a little bit rough over this last couple of years. I do believe in the long term, it's going to be great. Now, through this last couple of years, we haven't had any issues with the storage unit funds that we're in, the mobile home parks that we're in, and oil and gas has been phenomenal. Oil has a tendency to rise with inflation and everything else because it's affected by everything. So that, and I really love cash flowing businesses. So, and especially if you can have a real estate asset that's got cash flowing businesses attached to it, parking lots is something that I've absolutely wanted to dig into. I haven't had the time to do a deep dive into it, but man, how great is it to own a plot of land that you don't really have to do a lot to, and people are just coming and paying you to park that. I mean, that's brilliant. The people that own the parking lots around these, NFL stadiums and things were really smart. They had great foresight. So, I've spent a lot of time over this last couple of years really watching and monitoring sponsors, because at the end of the day, it does come down to that sponsor team and how are they weathering this rise in interest rates. How are they weathering the rise in that? How are they passing this off to their investors? Are they taking bullets for them? How's that going? So I've paid a lot of attention because I have been just waiting to see how that happens, because I'm not a multifamily operator. I know how to look at things, but there's a lot of multifamily out there. I want in it. But at the end of the day, I want that jockey that's navigating all of these ups and downs and the ones that are taking those bullets for their investors. So that's what I've really been paying attention to. I can't specialize in everything. The couple of things I do get into, I deep dive hard. And I want to be able to talk about it on a really educated, high educated level. And not only just for myself, but to be able to pass that on to my investors as well. I think it's really important to understand that asset class, understand those risks, understand where the potential deviations might be. And we've learned a lot about that over this last couple of years, big time. So people will be a lot more strategic about how they invest in the future for sure.
I love it. Completely agree. Go ahead.
Oh no, I was just gonna say, and this has come up a few times, and there's been some questions in the chat about, I was picking sponsors and vetting sponsors. It's not just, and Courtney mentioned this, and Kevin mentioned this. It's not just the asset class. It is very much also the operator. And I'll give you an example. Is, like multifamily right now, like Courtney, you just said, oh, your multifamily investments aren't paying out. In 2023, on our portfolio, we paid out more in distributions than any previous year since we started, right? Because we did fixed debt, and like Kevin said, the fundamentals are actually good. So that's another process, a part of the process of vetting and deciding, how you're going to invest is look deeper than just the asset class.
Yes.
Because Courtney, from all I've ever heard of her, has a spotless reputation in oil and gas, and I've heard nothing but good from her. I've also come across oil and gas people who I've heard lots of nightmare stories. So is there a problem with oil and gas? No, there isn't. Is a problem with the person who was pitching the investments. So, like Kevin said, he used the jockey and the horse analogy. Any of these investments, as you're diversifying, in my opinion, you don't have to fully understand the niche. Like if I'm going to invest with Courtney in oil and gas, I'm never going to understand even a fraction of what she does, but I trust Courtney, right? And so that's why I would invest in oil and gas. Or if I'm going to place money in mobile home parks or parking lots, Kevin's the guy that I'm going to give that money to, especially parking lots. I don't know anyone else who does it better than Kevin. So it's really, yes, have some fundamental understanding, but it's coming down to the sponsor, because a great sponsor can take a tough deal and turn it into a home run or a great deal, but a bad sponsor can take the best deal in the world and run it into the ground.
Yeah.
So.
Yep.
And that leads.
Yeah.
Mhm.
I was just going to
So
say, I mean,
there's
I truly think the actual sponsor it's more important than the actual deal itself. I mean, for the most part, because to your point right there, Andrew, I mean, a good sponsor can take a mediocre deal and actually polish it a little bit and actually turn it into something, where a poor sponsor, again, could take the best deal ever. Like, can't lose on this one, but somehow they find a way to screw it up.
Found a way.
And we've all seen it. We've all watched this happen.
Yeah.
And I think that leads into, how do you, the next question, deal with the risk, the due diligence of sponsors, the due diligence? How do you go about doing that? We've got lots of asset classes here. We've got oil and gas, parking, mobile home, multifamily. I got a debt fund, right? How do investors, passive investors, go about venturing out into this world, finding the best sponsors, finding the best asset classes, and doing the right, what you would call that, due diligence? Go ahead, Kevin. Let's hear what you have to say.
Yeah. Again, I mean, I think we've hit a lot of these points, but just, and there's some science behind it, right? Like, you want to find, I think first and foremost, let's back up like a couple steps. I think it's an important something we need to hit on is, if you're someone looking for a passive investment, you're looking for the right sponsor. I think first and foremost, you need to have a very firm understanding of like, what are your investment goals? I think all too often, I think a lot of, especially new limited partners or passive investors, they get caught up in just the hype. There's a lot of hype out there now with, there's a million podcasts, there's a million webinars, there's very fancy, glossy marketing material. Right. And they get caught up in that. And even just getting caught up in like IRRs, it's like, and half the time they don't even know exactly what, how to come up with that. Right. And what does that mean for them? And more important, what does that mean for like their overall investment goals? And so again, just backing up, like if you're new at passive investing, you're looking for the best investments, like just have a really firm and, understanding, clear and concise picture of like what your strategy, like what it needs to look like, kind of where you want to be, and then back into it. And then you can start identifying investments that maybe make the most sense for you. Right. But as far as like vetting sponsors, again, track record. I mean, first and foremost, track record. How long they've been in the business? It's huge. Right. Were they, and nothing wrong with this, but like, did they start investing in like 2012, 2013, when it was really hard to, in fact, from that point up until, in the last couple of years, it was very hard to do anything wrong, right? Like a rising tide lifted all boats. And so now we're starting to see some of the exposure, right? Those that are actually, that maybe didn't have their underwear on, right? Like they're being exposed. And so the track record's huge. It doesn't mean that you had to invest, prior to 08 and how'd you make it through 08, but like a track record is incredibly important. Understanding what that looks like. Again, on top of that, strong balance sheet. Like and I can't hark on that enough. Like how much have they actually put their own money into the deal? How much money do they actually have, right? Like what is the financial health of their company? These are questions that you should be comfortable asking. And if there's nothing to hide, they should be comfortable, sharing that answer with you. Just what type of financial health are they in? So in the event there's like some challenging times ahead, can they carry this asset through the storm and protect your money, be a fiduciary of your investment and get you onto the other side, protect your investment, and then ultimately help you see the finish line. I see there's a lot of folks that are just getting into the space. I mean, they're out there raising capital, doing deals, but don't have like two nickels to rub together. Like that's scary. Like what happens
Yeah, it is.
when things go bad? There's a lot. It just is what it is.
Right.
It just became a thing, right? And I'd say that, one thing that I've always done, and it's not right or it's not wrong, it's just the way that I've done things. So, I've owned a lot of other things over time. When I went to buy my first mobile home park, it was 2011. I'd already been investing for over a decade. So one could say that actually I knew a little bit of what I was doing, right? But we're always looking to learn more. And so when I looked at that first mobile home park, there were some unique nuances that existed in that asset class that, while there were similarities with multifamily, but there was a lot of unique nuances that existed that I didn't know yet. And so I literally, from 2011 to 2016, I ended up buying the first 10 parks with all my own capital, right? I didn't risk others' capital on, proving out the business plan, proving out whether or not the thing was going to make money. I mean, it made money on paper, but let's really get down to brass tacks. Like, is it going to make money? Am I going to be able to follow through and actually execute on this as I had laid out? And so, just again, what's the story behind the sponsor? For us, I risked my own money before I was willing to risk any investor's money on mobile home parks, and I did it many times over again. And so, just having that just rounded understanding of who that sponsor is that you're basically getting in bed with, you're getting into a marriage with, potentially for just a couple of
Absolutely.
years, maybe for 10 plus years, depending on
Mhm.
what their business strategy is. So,
Yeah. Courtney, anything
Yeah.
out of that?
Yeah, so I dig in pretty hard. I Whatever asset class I'm in, I will look at what they're doing. I'll ask them, what are some of the challenges you faced? How did you navigate that? And then I also will start contacting other people that I know specialize in
Mhm.
that field and ask them about that. And then I will even hunt down the people that have been investing with them to find out what that experience has been like. How's the communication been? So I dig into all of those different areas because their reputation, if I'm in oil and gas and I'm looking at doing a deal with somebody, I will call all of my oil and gas partners that I know and say, hey, what do you know about these people? Just to get an overall feel of what these industries are not huge. They're small worlds. And if you're doing things right, you'll have that reputation in that field. If you're not, you will also have that reputation in that field. So I dig down in a bunch of different ways to figure that out.
Well,
And
so sort
I'll,
of point at that a little bit more, because not only do you look at just your referral network, but you look at the sponsor and look at past companies, and then you assess the success of those past companies, right? And look for complaints and violations in past companies as well. I've been really impressed by that very thorough level of due diligence that I've seen Courtney do in the past.
oh, well, thank you for that.
Yeah.
That
So
came from hard lessons.
hard lessons, right?
Yeah.
Yeah, exactly.
Yes.
Well, you know what? We've got a lot of questions. Before we get to the questions, do we want to give it, and right around 45 minutes is when we do that, do we want to give people an opportunity to let us know how they can get a hold of us, what we have going on and how we can get a hold of us? And please make it short. We're not, we want to get to some Q&A at the end here, and we can finish off with some more discussions, but we start losing people at 45 minutes when we need to wrap up about the hour. So why don't we kick it off? Courtney, why don't you go, then Kevin, then Andrew.
Yeah, so you can find me at CourtneyMoeller.com. It's the same thing on LinkedIn. I'm very responsive. I love having conversations about all of these things. So, and actually, I'm hosting an advanced tax strategy summit next month that Patrick will be speaking on. You can come and dig into that at advancedtaxstrategysummit.com. Come join us. We're going to have great things.
I can't wait. I'm looking
Yeah.
forward to it.
Yeah, so for me, you can find me one of many places, but kevinbupp.com, my website. You can also find me on all the different social pages. I'm very active on LinkedIn, very active on Facebook and Instagram. And if you want to, get a better sense of what we do over at Sunrise Capital Investors, go visit there. That's where we focus on mobile home parks and parking assets. SunriseCapitalInvestors.com.
All right. So my friend David Green says I am a walking LinkedIn. So that is the only social media platform you will find me on. I am not on Facebook. I'm not on TikTok. I don't dance. You're not going to see me on Instagram. But please do connect with me on LinkedIn. If you comment on my post, that actually is me responding to you. It's not a VA in the Philippines or a chatbot or anything like that. So that's a good way to have an actual conversation. And if you want to connect more thoroughly, our website, vpacq.com, short for Vantage Point Acquisitions. There's a tab on there for how to connect with us. Just go ahead. We're not, you don't have to submit your life story or promise your firstborn or anything like that. It's real quick and simple, and we love talking to everyone and meeting new people. And we're hiring right now, so if you're looking to maybe join a multifamily team, go check that out.
Yeah, on my mastermind channel, Andrew has been asking people if they know any good asset managers out there. So he is. So Patrick Grimes, Passive Investing Mastery. We have an acquisitions fund taking down commercial real estate assets at opportunistic times. I think we're in the middle of the good old days, the second best buying opportunity of our lives. I missed the first one. I was being drug over the coals real bad. So learning my hard lessons. So, and then we have a debt fund, which is another way to invest in cash flow, just lower on the capital stack. And passiveinvestingmastery.com. If you want to set up a meeting with me, I give away a copy of this book. It was a bestseller, Persistence, Pivots, and Game Changers. I sign it and send it out just to share a little bit back on trying to motivate people and inspire them to go down the journey of alternative investing and how I made my journey from high tech to amongst these great people here on this panel right now. So we got some great, please everybody jump into the poll. I know a lot of people join with their phones, and if you're joining with a phone, what you're missing is a really fun dynamic chat, and you're missing some handouts that we've had, and you're also missing the polls that we're putting out right now. So, and thank goodness we didn't get any pours. We only got mostly amazings here.
Not
So.
yet. No. Well,
Yeah.
and Patrick, you were talking about people dropping off. We actually just hit the highest attendance of the whole thing, so I think you're doing a good job keeping people on. So,
well, the bad jokes are only going to get worse from here. So we had some more things. Talk about economic climate. Do you see? Well, and we can go into questions right after this last one, but I would like to understand on the economic climate. Do you see things getting better from here? Or are we headed for more? I think that you said we're at the peak a couple years ago. Jerome Powell just put out a note on February 6th here that said the impact on commercial real estate on the banking system is yet to begin. So the impact for commercial real estate on the banking system has yet to get even started, he's saying. And we're already starting to see loan modifications. We're already starting to see distress. Are we going to see things improve from here, or is there still more bottoming out to happen?
Yeah, I'll jump in on that. I think first of all, you have to define what improve means, right? So right now, like what's happened in the multifamily market the last 2 years, to me, that's an improvement. I am no longer competing with 68 other offers on every deal that I look at. And 67 of those came from, a boot camp 3 weeks ago. And like Kevin said, don't have two nickels to rub together. And now those deals are all going bad. So that's improved. Pricing has come down about 20 to 30% in multifamily. That's an improvement. I can buy stuff way below replacement cost again. Operations fundamentals are actually still quite strong. And so to me, this is an improvement in the market. I would much rather be here today with actually, I would say more realistic, more normalized interest rates than where we were 2 years ago. In terms of where we're going, I'll kind of stick to multifamily and let everyone else address the other asset classes. Number one, I would say we all tend to get a little focused on predicting it's going to be here. The 10-year is going to be at 3.86% at the end of 2024. None of us are going to get that right. If we do, it's pure luck. Really, what we need to do is think in terms of probabilities. What is the most probable outcome? Build a business case on that, and then hedge against the other outcomes, right? So for multifamily, to me, in the general economy, the most probable outcome right now for going through maybe the end of 2024 is interest rates probably stay relatively similar to where they are for the next 12 months. The Fed generally doesn't like to make big moves in an election year because they don't want to get accused of being political either way. The economy, there's some data that comes out and says, oh, it's getting weak. There's other data that comes out and says, holy crap, it's unbelievably strong. So it would seem the most probable outcome right now in the near term is the mythical soft landing. But that doesn't mean something could change and we don't get a hard landing, which if we do, then interest rates probably come down significantly. But there's also a meaningful chance that, if we get another high CPI reading in March, the Fed could say, guess what? We're bumping at 25 basis points in June instead of cutting it. That is a non-zero probability. And so if you're, the mistake is to sit on the sidelines and say, all right, I'm going to wait till this settles down and it's a clear picture. It's never a clear picture. There's always risks. There's always things that could go wrong. And so that's why, we're looking at saying, okay, invest in oil and gas, invest in mobile home parks, invest in multifamily that makes sense today with today's interest rates and today's economy, but gives you cash flow from day one, but has potential for growth and upside down the road. I feel like that's where we are in multifamily. There's going to be distress, there's going to be foreclosures, there's going to be people forced to sell because their loans are coming due, but there's also a grip load, and that is a technical term, of capital on the sidelines, anxious to scoop those deals up. So I will venture to say that in terms of in real time, multifamily pricing has probably bottomed. Maybe in some markets with a lot of supply coming online, you might have 5% more or something like that to go. But I have seen just in the last 3 months, deals that we're looking at, instead of finally ending up a little below what the broker said, we are now going back to, and the final prices are ending up a little above what the broker said. That to me suggests there's a sentiment shift that has occurred. We're not going to see it in the data for 6 to 12 months down the road because it takes a long time for this stuff to close. But the sentiment has shifted, and again, part of it has to do with capital looking for a place to go. So, if you're looking at multifamily, and you're saying, what do I do going forward? I would say very carefully buy for the next 12 to 24 months with a plan to hold for 5 years or longer. And it's very difficult for me to imagine, if you buy a good property in a good location and operate it and finance it right today, that you're going to regret owning that 5, 6, 7, 8, 9, 10 years down the road.
Agreed. I think he's spoke true, but Kevin, let's hear what you have to say.
No, I was just going to ask a follow-up question to that, Andrew. Just because I think I had the right takeaway, but I just want to confirm. So, but when you're underwriting, when you're looking at opportunities today, like it needs to make sense economically today with the debt that you're putting on it today. Like it's actually got to pencil out, correct? Like you're not looking at pie in the sky 2-3 years down the road, 5 years down the road, correct?
Correct.
Let me apparently, because I'll get a little bit of a spin. We're not actually penciling the same way we used to pencil. I don't think you can put the old metrics on the new deals. In fact,
correct.
Being the analytical engineer, we've seen rents flatline or go the other direction, and the correlation from CapEx expenses to rent growth simply not there right now. And with inflated cap rates, with inflated expenses, with insurance and taxes, all those things putting pressure on the income, the only way that I see buying that makes sense today, if I was to lean into Andrew's point about time to buy, it's if you can make the return on the buy. You can buy it at a low enough basis where you've made your return and you don't have to hope that all these scenarios where maybe the interest rates go up, maybe they go down, maybe we're not at the bottom, but you would at least built in that cushion going in, and your returns aren't predicated on 2 or 3 or 5 year hold of uncertainty and trying to correlate the old school CapEx to rent growth. And that's our entire acquisitions fund is built around that strategy. Make the return on the buy, don't hold it, sell it and buy a new one. And that's the only way I'll lean into acquisitions right now.
You made I just want to highlight a point that you made that some folks tuning in might have missed. You mentioned that rents, in a lot of markets are flatlining. In fact, some markets, the rents are actually going down. And I think that the storyline up until probably a year ago, at least 99.9% of the storyline was that rents never go down. I mean, and that's been the same false storyline that's been played out over the last like decade. And I can tell you from personal experience, 08 through probably like 11 down here in Florida, I owned a lot of assets down here in Florida. Florida was kind of ground zero, as was like Vegas, as was Southern California, as was Phoenix, right? Like those are like the big hit markets back in the 08 real estate correction. And I can absolutely 100% tell you that rents went down for a couple of years throughout all the major markets in Florida. And so it absolutely can happen. It's happening. And so when you're looking at an opportunity, per Patrick's point, like it cannot be underwritten like it was historically years past. Like it's a different world that we're living in today.
And Courtney's looking at us like silly boys. We should be in oil and gas right now because oil and gas is going like this. Come on, what do you?
Yes, but I think this is where people need to really shift. Jason Hartman, I love that he says compared to what? Okay, we're penciling stuff out at 7% or whatever, and it's obviously it's worse now compared to a year ago or 2 years ago. But how about when interest rates were a lot higher at 15%? I think it's just a matter of shifting your mindset and shifting those expectations and finding those right deals that are penciling. And I think there's going to be some really great opportunities. I think, Andrew, I tell you what, then in my next multifamily deal, I'm coming in with you. I mean, just knowing that you took that route in a totally different way than everybody else out there in that market, that's a big deal. That's a huge foresight. And those are the types of things that matter. And those are the kinds of people that I want to be investing with because they're looking at, okay, there's issues here. This is what we need to lock into. And that's the kind of things you want to pass on to your investors. It's such a big deal.
Mm-hmm.
And, oil and gas, I'm sorry, I just was going to throw one more thing out there. The oil and gas stuff, what's really important for that, depending on what you're getting into, is what are those oil prices going to be for the next couple of years? What do you think? Obviously, none of us have a crystal ball. I can't sit here and determine. I couldn't predict that interest rates were going to go up the way that they did and that insurance rates and tax rates and everything was going to happen. But there are things that you can turn around and take a look at economically. Like I said, when everybody's all excited and this and that, and we're seeing tons of people move into the oil and gas space, which is actually really concerning to me. People that aren't traditionally in that's not their traditional offerings. And it's really concerning. So.
Well, they're fleeing for yield, right? Because investor sentiment's so low. There's one aspect that's not being really shared here. And in a high interest rate environment, it's really unfortunate for common equity, right? And that's really what we're talking about. It's advantageous for placing new debt in this environment. Right now with interest rates high and inflation high, we've seen a lot of issues right now with the current banking system. We've seen banking failures, and that's resulting in some troubled issues in the debt market. But the reason why investors, I think we should make it very clear that there's more than one way along the capital stack to invest. We see a lot of people only thinking about this common equity. Like, we put your down payment on a single family home, that's the equity, right? But you get a debt component. That's usually most of the investment. Who are those guys? Those are the guys that are actually making the interest payment. And traditionally, those are like 6 to 8%, right? But now, today, in this economy, you can get 13% interest rate, lower position on a first position payout. And so I think it's important to make sure people are clear that some of the returns you used to only be able to get on a high risk equity investment, where the volatility is right off the top. Every single penny of that volatility comes off the equity. Whereas if you're in a low leverage debt position and you're in a debt fund that's low leverage, you're sitting pretty well below that volatility. And you don't get the upside necessarily. But man, equity deals that are out there, people doing common equity 14, 15, 16%. And some of the debt out there right now is that because banks are like pencils down. Because I think it's important people search to look for not just diversification amongst different asset classes, but search to seek diversification amongst the capital stack within those asset classes as well. Warning though, not a pref fan, not a pref equity fan. So there's like the debt and then the equity, right? And I'm gonna tomorrow, Andy and I are gonna be in a mastermind. I'm gonna bring this up because we have a couple of pals with pref funds now. I'm just teasing. But right in the middle, there's usually like a mezz debt, like a second position, where you may, your home, you're going to get a refi or something, get a second position, I mean, to remodel your home. But then sometimes in commercial real estate, the preferred equity, and there's a lot of funds out there that are rescue capital or preferred equity funds. Got to be really careful with those. Some of the sponsors out there are really good. They are taking advantage of some opportunistic positions right now, and some are kind of raising that to salvage their own deals, and it can be higher risk, right? So
Yeah, there's a
when I say
lack
debt,
of
don't confuse
transparency
it.
on those.
Yeah, don't confuse it with preferred. I get a lot of calls. Oh, I'm in a debt. I've got a preferred equity fund. I'm like, that's not what that is. That's not what that is. Just to be clear. All right, but I know, Andy, you also invest in some of that fixed interest stuff too. This being a cash flow, what are the other kinds of cash flow we can get that's not common equity, right? That's not on that volatility curve.
Well, like you said, you can invest in debt positions. There's a million different ways that the capital stack can be put together. And if you're looking to diversify away, like for example, if you have investable cash right now and you're just waiting for the right deal to come along because you're like, yeah, you know what, this year, next year, I might, there's going to be some great deals. I can tell you something that we've done with even the reserves at some of our larger properties. So we have, some 250 unit apartment complexes that carry upwards of $2 million in cash reserves. So what we've done with that money is we've opened accounts at Treasury Direct, which is literally the U.S. Treasury. And you can buy 4-week T-bills, which means it's a Treasury bill that matures in 4 weeks. So your money comes back every 4 weeks. It's not tied up for a long period of time, and that's paying 5.2%. So you can stay liquid effectively. Like, I mean, if you're going to invest in a parking lot deal or multifamily or whatever, odds are you're going to have more than 30 days to actually make that investment. So that's a way that there's unique ways now. Well, I didn't say unique, but there's ways now to generate truly passive income that weren't there a couple of years ago. It's not all bad that the Fed raised rates, because if you had a couple million in cash or even 100,000 in cash sitting in an account 2 years ago, it was earning 0, and that's nominal. That doesn't factor in inflation. It was negative. Right now, you can take that cash, whether it's $100 or 100,000 or $1 million, go directly to the U.S. Treasury, earn 5.2, and then we won't get into the argument about what the true inflation rate is. Let's just go with the government numbers for now and say it's 3%,
right?
Yeah, we don't want to get into that. So let's just pretend or say that inflation is 3.2 right now, and you're getting 5.2 on a 4-week T-bill. You actually are making a real return. That wasn't the case a couple of years ago. And so that's another way that you can kind of have it both ways. You can earn truly passive income while positioning yourself to be able to take advantage of the deals that guys like Kevin and Courtney are going to dig up in the next couple of years. Or Patrick, Patrick's stuff is going to yield a lot more than those T-bills. But again, it's just temporary. So there's no such thing as a bad market, just a bad strategy. Right. And you have to make sure that you and your sponsors that you're investing with are adapting to that market.
Yeah. Yeah. I mean, gosh, even a high interest earning savings account, I think they're probably paying 4.5% now. Right. And there's no limitation of, how long that money has to be in there or when you can get it out. Right. And you got like immediate liquidity access. So yeah, your money should not be sitting around doing nothing at this point in time. I think that's the point you're trying to make. It's a very valid point.
And I couldn't agree anymore, because we're doing the same thing with, instead we're not using T-bills, we're using in our acquisitions fund. When people invest and we don't have a deal, we put them in a 7% note, right? And that's a 90-day note. And then if we have idle capital on our acquisitions fund, we put it into a 7% note because we don't want to be losing with inflation. So that's absolutely a strategy that a lot of operators should be looking at. Of course, it has to be disclosed in the fund docs, and you have to make sure that you have the framework for that legally. But once it's there, the investors will thank you, right? When we submitted that update, hey, here's an update to the PPM. We're thinking about hedging inflation by, putting this idle capital into these, vehicles. People were like, why didn't you do that a year ago? So we were actually surprised to hear that feedback.
Well, all of these issues that have been created start creating strategy, and people start getting smart about what they're doing and finding creative ways to create additional yield, right?
Yep. All right. So let's jump into some questions here. I've been watching the attendance. We've only lost one or two, so we've had a lot of audience members really sticking in here. So let's see. We've got you have to vet the deal, but you really have to vet the team. I think we covered that. How are mobile home parks performing during this downturn? Did COVID affect parking? I'm sure that one's for Courtney.
Yeah.
Oh no,
Okay.
that is totally for Kevin.
Yeah,
Yeah.
yeah. So I mean, as far as mobile home parks, I mean, we own yeah, I'll speak to mobile home parks for that's like a two-part question. So
Mhm.
I'll speak to mobile home parks as far as like how they're performing today. They're fantastic. Again, a lot of that's, related to also the market that they're in. And there's a lot of people, everyone can agree that we have a huge demand for affordable housing, in most of they say throughout the country, but there's actually some markets where there's a lot of affordable housing, right? And so we're very strategic on what markets we go into. And each and every one of our mobile home parks is in a great market, and our delinquency rates are incredibly low right now. Speaking of COVID, every state handled it a little differently. We own mostly in red states that are very landlord friendly, but even then, we had challenges like everyone else, right? Like most of the red states, they paid on time. They continued paying as they would have. For those that truly had financial challenges, I mean, we had a dedicated two people in our team that literally was the workout team, right? Like we payment plans together, and like we did anything in our power to keep people in their homes. But inevitably, when it all shook out in the long run, we ultimately had some vacancies or had some evictions that came about that were a result of COVID, right? Mostly folks kind of working the system, strategically working the system, not necessarily financial hardships, right? On the flip side of that, we also owned, which we no longer own, we owned in New York. We also own in Maryland. We still do. New York is very blue in comparison to Maryland. But in New York, we had an absolute headache of a time during COVID. And just, again, more strategic delinquencies from the resident standpoint, just selectively choosing not to pay because there was protections completely around them. And we had, situations where up to 20% of our resident base, we couldn't do anything, and they chose not to pay. And so we're no longer in New York. We sold those assets. We actually, we took advantage of the timing of like 2020, even with those delinquencies, everyone started buying, was in this buying frenzy. And so we really took advantage of that, of the buyer's market at that point, and or seller's market, I guess you could say, and took advantage of some of the ridiculous prices people were paying. So, long and short of it, mobile home parks are doing great today. They've got historically sound fundamentals through recessionary periods of time. Now, parking in general, if you just look at it as a whole, what happened during COVID? If it was parking that was reliant upon office, like if it was an urban core setting and it was reliant upon office, then it got its butt kicked. I mean, it literally was in horrific shape because, as you guys know, most downtown areas were closed. Even in some of the more open states such as Florida, there was a period where still like the downtown urban cores were closed. So with that being said, most of our parking assets are very strategically located. Either they're in tourism driven locations. So for example, one of our premium assets we have, it's literally in Clearwater Beach, and we actually bought it during COVID. In fact, Clearwater Beach, Florida saw like there was about 4 months of a downtrod. And then literally it was like through the roof, like blow the roof off. And it performed
My wife and I
incredibly
spent
well.
3 weeks in Clearwater during
Yeah.
COVID. So it was
And
hopping.
so it was,
I mean, COVID didn't happen there. as far
I'm
as
very
I'm
happy
concerned.
that we bought that asset
Yeah.
even during COVID. Right. And so like, and then so we've got 5, we're very strategic in how we look at parking. It's got to have 5 unique demand drivers associated with it. So, unique demand driver would be entertainment, sports stadium, retail, restaurants, government, like a courthouse. And then, office is kind of like, that's like a 6th one that we don't even really care about too much. And so most parking assets, they were built, if they're in the urban core, they were built, to support either a dedicated office building or maybe a number of office buildings and maybe some hotel and things like that. We won't even consider a parking asset if it's got more than like 20%, if it's supported by more than 20% office. Because I'm a firm believer. I think office has come back about as far as that it's going to. I think it's about as good as it's going to get. Everyone's got a different opinion on it. I think we're far enough past COVID, and enough employers have really said like, get back in the office or get gone, right? And it hasn't worked in most instances. And so
Right.
we'll only look at parking assets that, again, entertainment, sports stadium, government's not going anywhere. We just bought a parking asset in downtown Phoenix, and last year was phenomenal for us. We were on the sidelines quite some time during the frenzy. It positioned us really well last year. We bought some incredible assets that were somewhat distressed. This one in downtown Phoenix was owned by Invesco, a big institutional group, and they had a debt maturity issue, and they were in a pickle. And so, but this one, literally, it's stone's throw across the street from Maricopa County Courthouse, which is the second largest courthouse in the country, in downtown Phoenix, which I don't have to tell you guys know it's booming, right? Like, just Phoenix in general is a booming marketplace. So anyway, all of our parking assets did well during COVID, and they're doing even better now, but there's still a lot. We probably look at 100 parking assets before there's even one that even we remotely even consider, because most of them are tied to office demand, which again, just in the crapper still. So
Yeah. Well, we got to power through some of these here because there's a bunch that I think are probably pretty good. Is there an ideal breakdown of diversified portfolio from alternative investments to stocks? And how would you break those up amongst your favorite asset classes, I guess? Courtney?
Well, I think that comes back to figuring out what that financial plan is and what your goals are and what you're trying to achieve. That way you can figure out how you need to distribute that. So, we've got a couple of guys that are going to be talking at the tax summit that are going to talk about that financial plan and building that roadmap and helping you figure out where you need to be deploying your cash. So I think that's what
Agreed.
it
And
comes down to.
I usually point, sorry?
It's going to be different for everybody.
And I usually point people back to the Tiger 21 allocations. They're one of the more wealthy groups. They have a 27% allocation in real estate, 26% in private equity. And then the rest is in like liquid capital, Andrew, like fixed income bonds and various things like that. And so I look at kind of in that real estate and private equity, there's really the alt asset space, and they're all about 50%. And then in there, you kind of want to split it up. You don't want to be all in tax advantage things. Some of the tax advantage things is risky.
Right.
There's a reason why it's tax advantaged, right? And there's a reason why the government's talking about bringing back 100% bonus depreciation for commercial real estate, because it's a higher risk profile. As investor sentiment's low, they need capital to come in and help rewrite the commercial real estate here in the country. So you got to kind of really play that out and towards your goals, where you're at in life, and all of us take investor calls. And this is a great question to choose to talk to the right sponsors, compare notes, see what they have to say, and see if those fit your allocation needs. Let's see if there's a couple down here. Let's see, due diligence T's. Yeah, so we got B's jumping in here saying you got to do the 5 T's for due diligence: team, track record, transparency, time, and trust. That's a good one to get out there because a lot of people can't see the chat. And there's a question about, do you work with non-accredited investors? We do not. Passive Investing Mastery, we've only ever been 100,000 minimum accredited investors. Andrew and Kevin?
We actually do still work with non-accredited because with one exception, every deal we've ever done is 506B, which means there's no soliciting. You have to be on our email list beforehand, or you're not going to hear about the deal. We don't post it on LinkedIn. We don't post it on Facebook or anything like that. So because of that, because we don't solicit or say anything publicly about our deals, we actually still can and do accept some non-accredited investors.
So if you're not accredited, jump on his list now, or else you won't have opportunity later. Right?
Yeah, you have to be on there before the opportunity comes. Yep.
Yeah, Kevin, Courtney?
Yeah, unfortunately, we do not. We're all Reg D 506Cs, so you've got to be accredited to invest with our group.
Yep. Same question?
I do a little bit of both.
Okay, that's awesome. I didn't know that. All right, I've got 2 more people to pass the non-accredited too. But even if you're not accredited, talk to us, right? Because you'll become accredited, and it takes getting to know early who the right people are and what to go learn and where how to invest to get there. So don't let that hold you back. Any advice for new investors wanting to get started? Courtney?
Oh man. Back when I got started, I was just kind of that spray and pray. I was throwing money at all kinds of different deals before I knew what I was doing. And I think I will just tell you that the one thing that I learned is just because somebody is standing on a stage doesn't mean they know what they're talking about.
Mhm.
I figured that out very quickly, and really sit down and figure out what your goals are. Like what's important to you? What are you trying to create? Are you trying to create equity? Do you need cash flow? What's going to get you to those things? And then let's sit down, talk to some different people, talk to Patrick, talk to Andrew, talk to Kevin about how that's going to impact your strategy and your goals, and get into those assets.
Love it. Yep. And Sean, great comment. He said, if your money is sitting in the bank, it's exactly like investing in a company where the CEO has come out publicly and declared his goal is to drive the value of his company down at least 2% a year. Well spoken. And I've got Forbes articles about inflation, and I've been harping on that. And that's why we created the debt fund, actually. So love it. There's a lot of questions. There's several in here about hotels. I don't think any of us do hotels, but what is your overall sentiment of hotel performance?
What I can tell you is it can't be that bad, because every hotel that I've stayed at in the last couple of years, whether it's a run-of-the-mill La Quinta or something fancy, is now charging me double what it charged me just a couple of years ago. So, and that's with no maid service.
Yeah.
Grab your own food, wash your own towels, clean your own room, like. And yet they're somehow still charging me double. So revenue has to be up. I actually do know some hotel operators. They seem to be doing really well and really happy with their portfolio, but that is definitely outside of my expertise. That's just anecdotal
I love it.
insights.
We all feel that pain, right? We feel the pain of their profits right now. So do you consider climate issues when investing both regarding asset class and geography, Kevin?
Climate change. I mean, not necessarily. Not in the two asset classes that we invest in. No, it's not a consideration. I don't know if I have anything else to add other than that.
What about
A
Courtney?
gas car and electric car still needs a place to park, right?
That's it. Yeah. Well, yeah. I mean, as far as like autonomous vehicles and things of that nature. I mean, like they have to go somewhere, right? I think we're a very far time away from a situation where we're getting dropped off by a flying Uber, and those things are going back to stage in the sky and float and wait for you to pick you up again, right? Or to where all Americans are going to get rid of their gas guzzling vehicles or even their electric vehicles. So yeah, outside of that, I mean, climate change is not a consideration for us.
And then the last one go ahead.
I was
will
just
wrap
saying,
up the
you
last
gotta
question.
just keep in mind timeline, right? If you're holding an apartment complex for 5 or 10 years, climate change is a multi-decade thing. And unless now, will I buy something on the beach on the sand in Florida? No. Will I buy something 5 or 10 miles inland? Yes, I will, and get the proper insurance. But climate change, it's a very long-term thing. So if you're looking at a 5 or 10 year investment, probably not your biggest factor.
Well, it's a long-term thing, but the effects of climate are killing in a big way right now. I've had two 500-year storms the last couple of years. So
yeah, 500-year storms are now every 10 years.
Yeah, and right now they're rerouting the lines right around some of with insurance costs. I think climate is part of the distress in the market today. But you're right, climate change over a long period of time. I think we're going to see kind of these stepwise functions where they kind of just do a catch up. And right now we're in the middle of one of those catch ups where like 30% year to year insurance has gone up because of the natural disaster. Whole carriers have left whole markets, right? I mean, it's just, I don't have any hair left to pull. I mean, Andrew can monitor his gray hair over the years, and I have to monitor my gray beard now. But yeah, I mean, I'm not, whether it's climate change or not, it is the storms and the floods are real.
Yeah.
Right. And those are,
yeah. So it's nearly impossible to get, speaking of mobile home parks and hurricanes, right? Especially here in Florida and in my backyard, it's nearly impossible to get. And we don't own at this point in time, we don't own any assets in Florida. And even if we did, I just looked at 2 deals a day, and they were within a half a mile of the coast. It's nearly impossible. It is impossible to get anything other than just a basic GL policy. You can't get business interruption insurance. You can't cover any structures, anything of that nature. And so you're either taking the risk without it or self-insuring, or, you're not buying here in Florida. And so for that reason, and on top of that is a lot of these parks in Florida, they're grandfathered in. And so, underlying zoning wouldn't support a mobile home park today. And so if they actually get, when drawing a blank of the hurricane that just hit Fort Myers and wiped it out, a lot of parks actually got demolished there. And, luckily the underlying land value had a significant value to it, but a lot of those parks, I mean, literally they were worth what the land was after it was all said and done, and they couldn't rebuild. So, we take all that in consideration when we look at an asset, but the closest thing we have to the coast is probably 50 miles. So quite a ways in.
All right, and we'll last ones for Courtney here, and then we'll wrap it up. We've only lost just a few over the extended time here that we've gone. We've such a great dynamic group. I couldn't ask for a better group of panelists and a very active audience here. So kind of a two-parter for oil and gas. Do you look to see if they're buying a hedge on the pricing? And the other is with the electric cars, what impact do you see that happening on oil and gas? And I'd love to answer this one, but I'm gonna leave it to you. And does that make it, and somehow there's a question here about coal. And because of the growth of electric cars, the need for electricity, is coal a good investment? So there's a three-parter, three questions wrapped into one there. Go ahead.
Yeah, gosh, where to start with that? So first of all, most oil and gas companies are not selling their oil spot on the market. They are locking in contracts, for 30, 60, and 90 days at a time. And so that is a really important question to ask when you're investing in somebody that is producing. What is their bottom line? Like, what is their break even number? So most of the time that's going to run in that $30 to $40 range. So it's important to understand at what price in oil, how long are those contracts, and where do you start losing money? Where is it going to start costing you something? So it's important to know that. And then, gosh, electric vehicles, that's not going to have any impact on the demand for oil and gas in my lifetime, probably not my kids' lifetime. Chris Martenson does a really beautiful presentation on everything that we need oil and gas for. It is so much more than just the gas in your vehicle. It is in just about every product that you can possibly think of. And there is not a renewable energy out there that is going to have any kind of impact on the demand and need for oil and gas, like I said, in my lifetime or any others. There's too many issues, and it just doesn't have the ability to take that on. So I really, at the end of the day, I like a Tesla. They're pretty. They drive really cool. They look cool. I like riding in it. It's not going to take over my car. It's just not. It's not going to.
It was actually Elon who said, hey, we've got to drill more oil and gas in this country. And the last time I looked at the numbers, it was 40% of the United States electricity grid comes from the burning of natural gas. So
it does.
Yeah.
And eventually we're going to see some pretty big issues because drilling permits have been squashed over this last couple of years. Demand continues to increase. And, there's a lot of speculation out there. We're going to see $300 oil. We're going to see this. And I don't know. Obviously, as an oil and gas investor, that's a really great, awesome thought, but that's really bad for our economy. We do not want to see that. Really, $80 oil is really good for people. You start pushing $100, $200, $300 oil, and that's bad. That's not good.
Right.
So
bad for everybody, and whole countries are going bankrupt when that happens, right?
yeah.
Well, hey, look, this has been an incredible panel. Thank you, everybody. We barely lost anybody. We went at least 20 minutes over than we typically do, but I couldn't stop it. It was just a lot of momentum, great conversation. Everybody have a good evening. Appreciate it. And we'll catch you on the next one. We have another one coming up in 2 weeks, and we're talking about private credit and debt funds. And we're going to have a whole panel of people doing different investments along the capital stack. So make sure to tune in for that one. We'll look forward to it. Thank you, everyone.
All right. Good talking to y'all.
Yeah. Thank you.
Thanks.